Hey folks, I'm best-selling author of The Power Zero, David McKnight. In today's video, you'll see my interview with podcast host Arturo Johnson, in which we discuss what Dave Ramsey doesn't want you to know about Index Universal Life.
So I live in Nashville, and I remember being a financial representative and having conversations with people about trying to get them to focus on retirement and life insurance, specifically whole life insurance. And it was always term and investor difference, right? So we're in this town where, Dave Ramsey's concepts are, you got to wrestle someone down to get a little bit more. And then I saw you create a video that kind of wanted to educate people on some of the things that may have been misunderstood there. And when I saw that, I was like, okay, this is somebody that's really smart and bold at the same time. And so I'm curious on, with saying IULs may be not for everybody, or the word we throw around nowadays is a scam, that may have been some misunderstandings in regards to that. So what's kind of your stance on is an IUL for most people, or what are your thoughts on that in regards to having something to hedge against the market and use for retirement?
Yeah, I think for people that are younger than 50, IULs, cash value life insurance, can have a very interesting application. One of which is what I call a volatility shield. Other people call it the volatility buffer. And here's basically how it works. In fact, Ernst & Young came out with a study a couple of months back that sort of vindicated this whole approach. And basically what they said is that if you can, instead of putting all of your money, all of your retirement savings, for example, into a Roth 401k, I love Roth 401ks, but instead of putting 100% of your retirement savings into a Roth 401k, put 70% into a Roth 401k and put the balance into cash value life insurance. And if by retirement, you can save between 3 to 5 years worth of living expenses in that cash value life insurance. And then in the first 10 years of retirement, and the year following a down year in the market, you can pay for your living expenses out of your cash value life insurance. That gives your stock market portfolio a chance to recover before you take further distributions. And that can actually raise your sustainable withdrawal rate in retirement to as high as 8%. We talk about Dave Ramsey. He's, you're in the home turf of Dave Ramsey. Dave Ramsey is famous for stirring up a hornet's nest, among CFPs across the nation, when he says, look, you can take 8% sustainable withdrawals on your retirement savings in retirement and literally never run out of money. He doesn't really talk about sequence of return risk. He just says, look, it's your stock market's going to return 12% year over year over year. Stock market's going to make a 12% deposit into your stock market portfolio January 1st of every year. Therefore, you can take 8% sustainable withdrawals every year. And he says, well, if inflation is 3%, then 8% plus 3% is 11%. That's less than 12%. Somehow he's making all that math work. And he's saying, then the math adds up and you can take 8% withdrawal rates. Well, what he doesn't account for is he doesn't account for the fact that 8% works when you have linear rates of return, like year over year, 12, 12, 12, 12, 12, 12. But it doesn't work if you have one or several down years in retirement in the first 10 years of retirement. When you utilize life insurance as a volatility buffer, like I said, you live out of your cash value life insurance in the year following a down year in the stock market, you can actually take 8% sustainable withdrawals on your stock market portfolio. Why? Because by living out of your cash value, you give the stock market portfolio a chance to recover before you take further distributions. So here's the great irony, Arturo, is Dave Ramsey. The only way to get an 8% distribution rate in retirement is by utilizing a financial tool that Dave Ramsey says is a hot pile of garbage. He says the only people that do it are people that are either easy dupes or they haven't researched it enough. 100% of cash value life insurance is crap 100% of the time. So this is what he says. But ironically, the only way to get what Dave Ramsey's preaching, which is an 8% distribution rate, is to use cash value life insurance. There's also a way to use that, use annuities to get it as well. But he also, condemns annuities as well. And so I think that IUL is a great way to utilize that whole volatility buffer concept. Number one, because if you need to accumulate 3 to 5 years worth of living expenses by the time you retire, you need to grow that money productively between now and when you do retire. Okay. And if you're only getting, say, 2 or 3%, it's going to take a lot of money, maybe even more than 30% of your retirement savings to build that amount of money. The reason I like the IUL is because, history shows that you can get 5 to 7% net of fees over time in your IUL. The other thing I love about IULs is that when you take that money out, you can take it out tax-free, like you can by way of a loan with all life insurance policies. But you can also take it out cost-free because IULs, through the right types of companies, have guaranteed 0% loans, meaning you don't have any penalty for not paying that money back. So you got tax-free, cost-free, you've got safe and productive growth. And that's why I think the IUL really fills that whole volatility buffer discussion in a really interesting way.
What are a couple other things that most people get wrong or that they don't understand about how the IUL works?
A lot of times, Dave Ramsey, and I hate to keep harping on Dave Ramsey, but you are in Nashville after all, so listeners probably hear about Dave Ramsey all the time. Dave Ramsey has this whole thing where he says that, whether it's IUL or whether it's whole life, he really loves to harp on the expenses. He says, look, you're going to, and that's frankly every financial guru, Susie Orman, Clark Howard, Ramit Sethi, they all talk about it's a scam. Why do they say it's a scam? The reason they say it's a scam is because the expenses are high, okay? Or at least they claim the expenses are high. However, it's really interesting. I liken life insurance to getting married. Okay, nobody gets married because they want to stay married for 5 weeks or 5 years or 10 years or 15 years. You get married because you're planning on staying married to that person until death do you part. And I make the same case in my book, Look Before You Learn, that you should not start a life insurance policy unless you're planning on keeping it till death do you part. Which means that for people like you and me, Arturo, I don't know how old you are. You look like you're 35 or so.
Thank you.
Your IUL, if you had one, you'd keep it for 50 years. Okay. In fact, if you decided to cash it in, it'd be one of the worst investments you ever made. So don't start that IUL unless you're planning on keeping it for 50 years. So it's a 50-year proposition. But what Dave Ramsey and Susie Orman do is they say, these are front-loaded policies, meaning you pay all the fees in the first 10 to 15 years. So they say, look at how much money you actually have after the first year. Look at how much money you have actually after the 10th year or even the 15th year. And let's say, what kind of rate of return is that? You could be earning 12% in the stock market. Why? This is the worst financial decision you ever made. However, when you recognize that the fees in the IUL in the early years are higher, but they're much lower in the later years, and then when you average those fees out over the life of the program, they can cost as little as 0.5% or less per year over the life of the program, because those fees just drop through the floor later on in the program. And then you average that out, and it's actually less expensive than the mutual funds that Dave Ramsey himself is recommending, less than the mutual funds that Susie Orman is recommending. They can be, in some cases, when structured properly, as low as a Vanguard index fund. And so that's something they love to harp on. George Kamel, Dave Ramsey's co-host, says IUL is a money-eating monster. It's got fees that are so high. But really, if you have a long-term perspective, and by the way, you shouldn't do this program if you don't have a long-term perspective. If you have a long-term perspective, the fees are insanely low, okay? And if you're planning on keeping it your entire life, who cares what they are in the first 5, 10, or 15 years? Like a mortgage, who cares how much money is going towards interest versus principal in the first year? You know that over the life of the program, you're going to eventually pay that loan off. It's much, much better with the IUL because you recoup all of your money much faster, and then you're in the black much sooner. And then, and what they also love to do is they love to say, hey, the IUL is, people love to, put it out there as a stock market replacement. And then they do comparisons of a 12% S&P 500 versus what you might be getting in an IUL. And like I said, you're only getting 5 to 7% net of fees over time in that IUL. And so it should not be compared to the stock market. The IUL is a bond alternative. Tom Hegna, one of my colleagues and friends and mentors, He's fond of saying, look, if you reach into your portfolio, you take out the bonds, replace it with cash value life insurance, you'll increase your return, you'll lower your risk, you'll lower the standard deviation of your entire portfolio and experience a better outcome over time. So this is not a stock market replacement. It's a bond alternative that has a lot of bells and whistles that are very, very interesting. For example, it gives you a death benefit that doubles as long-term care. You grow your money safely and productively, and it serves as a great volatility buffer in retirement. Okay, folks, that was my interview with podcast host Arturo Johnson. Folks, in the next 10 years, I'm looking to put 1 million Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davemcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally, and don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.